Welcome back to Financial Guru as we look at dividend investing. Is this the strategy for you to make your dreams come true? In this video, we will look at the dividend strategy through what is dividend investing. You learn what that is about. Then we'll look at the dividend safety through payout ratio. How does the company earnings compared to the dividend affect if the company can sustain the dividend? And then we will look at a few companies and what their dividend is at the moment and compare a couple of companies. And then we'll look at a couple of strategies for you if you'd like dividend investing from this video. So what are some strategies you can do? Well, remember, anything I tell you, make sure to do your research and come up to your own conclusions before investing into any stock or any investment, not financial advice. Welcome to Financial Guru, your one-stop shop for everything finance. And today we're going to look at dividend investing. First off, what is a dividend? In simple terms, is a part of the company's earnings that has not been reinvested back into the business, and it's given to you as a shareholder if you own stocks in this company for a little piece of the pie, and they return it to you. But what is the benefits of getting a dividend? Of course, you're getting extra money that you can reinvest into that exact company, which is called a drip. Or what I like to do is to invest into whatever one is the best price at that stage for me in the current market, whatever's the best opportunity. That's what I like to do when it comes to reinvesting a dividend. Although there is a few pitfalls for dividend investing that you have to look out for, is that the dividend can be cut at any time, which is very costly for you, because often if the dividend is cut, the stock price goes down 25%. If it's cut altogether, at least 50%, if not more, and you're really in downhill street from there. So you've got to make sure when I talk about the payout ratio, you understand that can the company actually afford the dividend? So what is the payouts ratio? Well, it's basically, to help explain this for a dividend, it's the cost of the business compared to its earnings. Well, I mean, how much earnings is basically given away to the company as a percentage, which can be calculated in a few different ways. It can be the dividend compared to the earnings per share, dividend payout. These are just different ways you can, and they can be looked at the total earnings minus the dividend. Just depends on what metric you use, but at the end of the day, it's pretty simple. If the payout ratio is low, more likely the dividend is going to be safe, and the more percentage higher the dividend ratio is, the less likely they'll keep the dividend in the long term. So let's have a look at a few real life examples so you at home can learn a bit more if you don't know about it, or if you do know a lot about it. This is just to give you the idea of what dividend investing is like in a real stage company. So let's look at Johnson & Johnson. This has been around for a very, very long time. They're known as a dividend king because they have consistently raised the dividend for over 25 years. And in Johnson & Johnson's case, or J&J for short, they have done it for 60 years, continuous dividend growth each and every year for you as the shareholder. But there's a but here with Johnson & Johnson. You're not expected to make a whole lot of money from the dividend over time. If you look at the percentage of only 6% over 5 years, so basically 1.2% raising the dividend every year is very low, and you're not going to go flying to the moon with Johnson & Johnson, but it is a fairly safe stock, and a lot of the richer people like investing in Johnson & Johnson because it's nice and simple. So the payout ratio for Johnson & Johnson currently is around 44%. So then nearly half of their earnings is going straight into the shareholders' pocket. Let's compare this to Apple. That has had a dividend growth for the last 9 years. Obviously, a much younger company than Johnson & Johnson. With their 5-year growth rate of the dividend of slightly better at 7.26%. But the great thing for you Apple investors out there, they can absolutely afford the dividend, and you expect it to be here for a long time to come, not financial advice. But with only a 15.6 payout ratio, woohoo! Yes, run all the way to the bank. And if you're an Apple in another 50 years' time, I would expect you'll be looking at least a 5% dividend then if you're looking at later on retirement. Woohoo! So I'm expecting Apple will start to raise that dividend eventually, but I'd rather them grow the stock more and more because you get more value for money that way. But if they can't, then the sweet dividend will be helpful later on. So let's have which stock do you think is safer in terms of the payout ratio? If you go on payout ratio alone, Apple is more likely to keep their dividend for the long term compared to Johnson & Johnson. But Johnson & Johnson have obviously had this whole life of 60 years guaranteed growth for you. So obviously they're not going to cut the dividend anytime soon higher. But if their dividend payout ratio starts to get to 70-80%, then you'd expect Johnson & Johnson to cut the dividend. But at this stage, it's more than likely not going to be in most of our lifetime, so Johnson & Johnson would be a safe bet for now. But for how long, I don't know. And that's the question when you do investing, not financial advice. So that's just 2 examples of companies that pay a dividend. And we want to have a look on the other side, the flip side, of the dividends being cut altogether. Thanks to the Rona. Yes, Disney stock as well as Carnival Cruise Lines have both cut their dividend altogether. They've promised to bring it back, but neither company is yet to bring it back. And will they ever bring it back? That is a big question. If they don't, they're going to falter for a long time to come, I believe, these 2 stocks. But there is still potential upside without a dividend, but if they really get the dividend, you'll see them start to skyrocket again. Well, not skyrocket, but go up quite a bit if they do return a dividend to the shareholders who originally got into the company for. So yeah, that is the danger of dividend investing, that it's not guaranteed. It can happen at any time. They can cut the dividend. So yes, and the main reason they cut a dividend is if their earnings is decelerating big time and they can't afford to pay the dividend anymore. When their payout ratio gets to 90-100%, it's just untenable. So that is one reason. Or they want to spend their money more wisely somewhere else instead of giving it to you as the shareholder. But most of the time, when the dividend is cut, a lot of money has gone out of the company for quite a while, for at least a couple of years, because most of the people have invested in their company for the dividend. And obviously with dividend stocks, long term, generally stay fairly steady and don't go up much in a bull market, but they're less downside in a down market, which we're at the moment, or in the middle of a returning to a decent market. But there's still some good buys out there at the moment in the dividend. But yeah, the good thing in the down market is that you get the sweet dividend. And thanks to watching this video, you're going to subscribe to the channel, because we're going to keep continuing to get that sweet dividend going into the future. Remember, this is not financial advice. Do all your research before following any random on YouTube. Now let's have a look at some strategies right here, right now, to make you some moolah, possibly into the future, and for you to do a little bit more research on before you start any of these strategies. So yeah, the first one for me is you can look at buying into very high dividend stocks. Okay, this is one strategy you can look into. It's just buying into heaps of high dividend stocks and hopes it'll go to the moon. But that is no guarantee, because the higher stocks have more, the higher percentage in dividend, often a higher payout ratio, and more likely can cut the dividend within the next 5 to 10 years, which can be costly, but if you get out the right time, it's not too bad. So it is a possible strategy, but a lot of risk involved. Similar with REITs, they pay a much higher dividend as well, but also at the risk of the markets and can cut their dividend quite easily as well. So there's a couple of strategies you can look at. One strategy I really like is to get the stock on value, growth potential, dividend plays. So what I mean by that, you want to get a company that's going through a few negative media comments or something just happening a little bit fundamentally, but it's only for short term, not long term. Then you can look at trying to get a 50% safety rating. So 50% margin of safety. So you say the stock's cut in half, gone to $25. You hope it's going to go back up to $50. You can get a 50% discount, and you get a sweet capital appreciation as well as the dividend and money coming in every quarterly or monthly or biannually, depending on the company. So that's another strategy you can look at. If you're going to look at this sort of strategy, I'd look at 5 stocks. If you're going to invest, say, 10K for starters for the new investors out there, or if you're going higher, it doesn't matter. If you got $1 million, or to me, if you have $1 million or 10K, you only need 5 stocks, at the most 10, but you could get away with just investing into 5 stocks and seeing your money go to the moon. And what I'll do, first before I do anything, I'll do the research and find the 5 dividend plays I want to invest in for long term, 100 years on the future. They're going to be the 5 big stocks in the dividend industry. You want to find the one that's on discount and start investing into that one and that one only. And if you have 2 on discount, invest into both of them evenly. Until you get to a stage you've either got to 2K in each, or if the price continues to be great, just keep buying and up to maybe even 5K, which might mean you go down to 4 stocks, but always buy the ones on discount. Do not buy the ones that are just at fair value. You find the discounts, that's great, and you can wait a few years, but just wait for that discount and then just load the boat, and that's when you can make yourself some decent money through dividend investing. So another strategy you can look at is what a lot of people do is diverse big time and have, like, say, 50 dividend stocks. To me, I don't think most people can understand 50 companies inside out. I think 5 companies you can know inside out a lot easier than 50. But if you want to do this strategy, it's a lot, well, you could say it's a lot safer, but I think you're going to be less likely to make that much money, because you're going to probably have 40 stocks that are going to be mediocre, if not more, and hoping for that one big one, where I think you can get 5 great stocks if you do the research. There's always a risk that there's going to be a stock that disappoints. It doesn't matter how good of an investor you are. The best investors get it wrong. So when you get it wrong, the best thing to do is either cut your losses if it's absolutely, this company's gone burger. But if the company is around, you just keep investing and wait for it to jump back up again. And that is the 2 strategies you look at when it comes to a disappointing stock. You got to figure out if the stock's going to continue to be disappointing and you need to sell out, or get into it and load the boat even more. The other strategies in dividend investing is you can go into one sector only and have 10 stocks in one sector, or you can spread out through a whole lot of sectors. Thank you very much for joining me, Barry Charles. Hope you learned on the video. I'll see you at the next video.